So finally, the dishwasher has stopped. I can get back to my nicer microphone. Precious metals. There's interesting two conflicting articles, if you will, on silver doctors. Clive Mond, the precious metal sector, tips its hand. Clive Mond believes gold and silver are headed for a major trip south of the border. And he thinks essentially they're going to, both go down. Silver and gold, they're both going to go down. He's, again, he's got the charts and the low lines. None of that crap matters. How many times do I have to say it? None of it matters when the markets are rigged. Oh, the 200 moving day average. Oh, it's above this. Okay, the club comes in and destroys it. Knocks silver down 75, 76 cents. Now it's back under the 200-day moving average. All that's fine. Means nothing. But this is more than likely kind of a scenario that I think is going to play out. Central banks and gold, a sea of change is coming. This is from Alistair McLeod. The very near future is likely to see a sea change in central bankers' attitude to the gold allocation in their reserves. And before I start that video I just did, I was telling you about Hugo Salinas Price and all that stuff. He thinks the reason why metals have been smashed lately is to keep them down, artificially down, for as long as they can right there, because they, the club, know much higher prices are coming. So if they can keep them down to start with, when the prices start coming, oh, we're back in the $20 something range for silver. Whoop-de-doo. That's why they've been keeping it below that 18 mark. Right now it's 17.29. They've been pushing and pushing these last few days. That's his thought, and I've mentioned that too. They're going to keep it down because they know it's going to explode one day. You don't want it exploding when it's already high. You want it exploding when it's way down here. So it doesn't have to go as high as it would have gone. Although, I don't think it's going to matter anyways, because once people see it exploding, you're going to have the people who are always late to the party, so to speak, get in on it, get in on the action, who are usually too late. That's when you and I will be selling, but remains to be seen. The future of G20 monetary policy since the financial crisis is causing a general rethink, which may eventually lead to a new policy direction. For now, that is undecided beyond a growing acceptance that today's monetary policy does not work, and the assumptions of recent decades that gold as money should be phased out might have been a mistake. And remember old Alan Greenspan lately? Yeah, we should have the gold-backed currency. Yeah. Well, Alan, nice of you to join the party. The idea that Western central banks could banish gold from the monetary scene over time has been disrupted by the persistence of Asian demand, fueled by the remarkable economic progress of ex-communist states embracing capitalist methods. Western financial markets have hardly begun to grasp the wider implications of the shift in economic power from the heavily indebted welfare economies to Russia, China, and other members of the Shanghai Cooperation Organization, and their consequences for gold. The welfare-driven states rely on money and credit expansion debt to conceal the true costs of their escalating government spending. They have been motivated to deny gold's fundamental role as sound money because it is superior to their unsound money. The increasing prosperity of Asians of all races who still value gold for its ability to retain its purchasing power ultimately undermines Western monetary policy as well as the propaganda that goes with it. The shift of physical demand from west to east has been widely chronicled ever since the Shanghai Gold Exchange became a conduit for escalating physical demand. Inevitably, the West's desire to demonize gold has accelerated the process, and we are now at the point where control of gold price could suddenly shift from Western capital markets, trading in futures, deferred settlements, and unallocated accounts, to the markets supplying bullion in Asia. This article discusses the Eurasian geopolitical issues that are becoming increasingly important for the near-term future of the gold price, and of course with it silver, and why many central banks are likely to increase their gold reserves at a faster pace than in recent past. It is a story which is partly political, but also now includes the consequences of the future failure of the Eurozone and its currency, the systemic failure of the Eurozone, raising fundamental questions for the Euro's future, and the risks attendant to other fiat currencies can now said to be in plain sight. Russia. We shall start with Russia. Something very interesting occurred last week. According to Izvestia, the Russian newspaper, Russia will pay off the only remaining debt of the old USSR. Terms have been agreed with Bosnia and Herzegovina for the payment of $125 million in final settlement, and this appears to be the last of the old debts, Russia having paid off the others and written off money owed by Cuba and several other indebted nations. So they paid off their debt and said, you guys who are really struggling, don't sweat it. You don't owe us anything. Interesting, right? So, this raises the question as to why Putin, demon to the West, instead of reneging on these old debts, which surely an evil man would do, appears to be removing all international claims on the Russian government. Meanwhile, foreign currency debt owed by the Russian government was about $40 billion in April 1st, 2016. And assuming it is unchanged, the rise in the ruble since then will have reduced it to only 30 to 34 billion equivalent. Much of this debt is likely to be in currencies other than the dollar. It compares with a current annual trade surplus of 12 billion in oil exports that alone are worth about 100 billion at today's prices. Russia's national accounts are in reasonable shape as well, with the budget deficit for this year under 2% of GDP, assuming oil holds the $50 price per barrel level. Price inflation is forecast to fall about 4% after hitting 12.9% at the end of 2015. In short, Russia has one of the healthiest set of government finances in all the G20. The central bank, by pursuing sound money policies, has played an important role in stabilizing the economy, despite trade and financial sanctions from the West and the West's attempts to destabilize it. There is overwhelming evidence Russia was targeted by the American defense and intelligence establishment with a view to bankrupt it. American presence was noted in the Euro-Maidan clashes in 2014, and according to Seamus Milne of The Guardian, the U.S. selected the administration that followed the ousting of President Yanukovych. Assistant Secretary Victoria Nuland in March 2016 confirmed in some detail the help given to Ukraine following Euromaidan, including over $760 million in assistance and two $1 billion loans. U.S. advisors served in Ukrainian ministries, as well as being embedded in the National Bank and related institutions. These advisors were in place when Ukraine's gold went missing, fueling suspicions it was sequestered by you-know-who, the U.S. The destabilization of Syria also had much to do with her relationship with Russia, both civil wars on foreign soil instigated by America and NATO. There appear to be powerful elements in the U.S. intelligence agencies still bent on driving Russia into bankruptcy, an objective that has failed miserably. It is the logical explanation behind the battle being fought between elements in the intelligence establishment and President Trump over future relations with Russia. Russia has won this one and can now afford to await developments in the American government. So why is Russia or the Russian government paying off all these old USSR obligations? Surprisingly, Russia has a history of honoring past obligations. But by doing so, Russia has cleared the decks to neutralize the impact of further financial sanctions. Alternatively, she sees global financial and systemic risk escalating and wishes to insulate herself from it. For the first case, she has eliminated dependency on dollars as much as possible, which is the primary control mechanism deployed by America over regimes she does not like. For the second, there is indeed much to worry about close to her doorstep. It has become increasingly obvious that the EU and the Eurozone, Russia's western neighbor, have been heading for political disintegration and an economic, systemic, and currency crisis, which has become unavoidable. When the worst happens, Russia's banking system will survive, while the West's will not. Russia's one remaining weakness, in Western minds at least, is foreign obligations in the private sector, and at current exchange rates, these are estimated to be about $400 billion. This is certainly a significant sum for an economy with a GDP of $1.3 trillion equivalent, but an ominous or omnibus figure of this sort tells us nothing about where and why these obligations exist, and of how much is in euros and dollars as opposed to currencies of Russia's neighbors. As a sound money advocate, in relative terms at least, Russia's central bank is likely to take the broad view that the private sector is not the state's business. Instead of hoarding dollars against private sector obligations, she is getting on with accumulating gold in her reserves, and one can see why. The problem with owning dollars, and therefore U.S. Treasury and T-bills, is Russia becomes a creditor of a strategic opponent who can potentially render these holdings worthless. The additional problem with owning euros and euro-denominated sovereign debt is Russia can be reasonably certain the euro will become valueless as the eurozone disintegrates. Russia is therefore detaching herself from both the dollar and the euro. That will leave Russia ending up with a reserve portfolio of mainly Asian currencies, particularly the yuan and gold. Gold has the further benefit to Russia of being the West's Achilles heel. Merely by accelerating the rate at which she accumulates gold, Russia can destabilize the dollar. However, she is unlikely to take this course of action without provocation and without acting in concert with China, whose economic future she increasingly shares. And speaking of China, both China and Russia, by their actions, show they understand the strategic power of controlling physical gold, with China also having encouraged its citizens to buy it. And given China's mercantilist plans, which over time should generate substantial wealth for her citizens, public demand for gold will continue to grow. Her problem is she still owns in her reserves about $1 trillion US dollars in U.S. government obligations. However, she is reducing it by stockpiling the commodities necessary for her expansionary 5-year plan. It will take time for China to extricate herself from such a large quantity of dollars and dollar-denominated debt, but there will be a crossover point where the losses of these dollar reserves from a rising yuan/dollar exchange rate are less than the fall in the yuan cost of imported industrial materials. At that point, China's interests will shift in favor of a gradual currency appreciation of the yuan, allowing the yuan to become the fiat currency of choice throughout the Asian continent. Whether and when China follows through with such a policy, only time will tell. But what's happening with China's dollar reserves is clear to most Asian central banks, who at least liaise with each other in forums such as the Shanghai Cooperation Council and the Eurasian Economic Union, both of which I don't think the U.S. is involved in. No representative over there. They know it is only a matter of time before their own dollar reserves will lose value and relevance because of China's ambitious policy to minimize use of the dollar in both her trade settlements and foreign reserves. It also places Japan in an awkward position. Notionally an ally of the U.S. and at odds with China politically, her business interests lie very much towards China and Southeast Asia. She should therefore, on trade grounds, reduce her dollar exposure, and she appears to be opting to smooth the path by promising to invest much of the proceeds in the U.S. In other words, she will swap dollars and dollar bonds for real assets in the knowledge that her more important trade partners are also sellers of dollar paper. Therefore, it looks like the Asian central banks are potential sellers of U.S. debt. Central banks for the smaller Southeast Asian nations must surely be tempted to jump the gun while they can, undermining confidence in the dollar for the whole region. For example, Thailand has $66 billion of U.S. treasuries, and shifting just 10% into gold at current prices requires the purchase of 164 tons. difficult to achieve when other central banks are buying in the market. The choice for central banks throughout Asia, whatever their strategic allegiances or alliances, is to replace dollar exposure with Japanese yen, Chinese yuan, or gold. We can eliminate the euro as a major currency because of mounting doubts over its future. He says more of that in the follows below. Goodbye, and I'll read this last piece and end it here. Goodbye to the euro in the Eurozone. Finally, we turn to Europe. Long before last year's Brexit vote, it was clear that the European political model, conceived in the wake of the Second World War, was outdated and unable to survive in the light of a changed world. Financial and trade power has shifted from the model of established trading blocs, such as the EU, in favor of emerging nations. Conceived along with NATO by America in the communist era, when the Soviets had to be contained, the EU is no longer relevant. Brexit merely exposed this fact. The EU, being conceived out of and driven by political objectives, always ignored financial and economic reality. When it was decided to introduce the euro, countries like Italy, France, Spain, Greece, and Portugal found their cost of borrowing in euros became a fraction of the previous cost of borrowing in their respective currencies. The result was an explosion of borrowing in state profligacy. Yet the inevitable credit crisis that follows a credit binge has been deferred and deferred. Eventually, the crisis will happen. It will be far larger through being put off, and everyone knows, or at least suspects it. However, the lack of economic progress in over-indebted EU economies is telling, and public discontent is mounting. And any EU national can now see that Brexit has created an attractive precedent, and that there is a better future in prospect outside this increasingly irrelevant union with its flawed currency. For this reason, Brexit is ringing alarm bells in the establishment everywhere in Europe. In upcoming elections this year, the Netherlands, France, and Italy, all being major components of the Eurozone, risk electing rebel administrations with policies aimed at escaping the EU's straitjacket. And if the rebels are denied office this time, they will gain more support as a result. Already we see capital flight ahead of this year's political risks building to record levels as Italians, the Spanish, and the French move money into German, Luxembourgese, and Deutsche banks. This capital flight is plainly reflected in increasing Target 2 imbalances illustrated below, which I will quickly show you and end this. Look at Germany too. But it's all over the place. Quite a long article here, but it was a good one. Again, just more reassurance for you to get your medals. If you're on the fence, I wasn't sure, you should be getting them now. Under $20 silver is a fire sale. Buying silver under $20, I repeat, is a fire sale. And if by chance the club does a number on it one time before they let loose and let it go up, oh, believe me, I'll be there. Breaking news, everybody. They knocked silver down to $11. Buy it now. Get a credit card out and buy it right now. That's the video I'll be doing, should that happen. I don't know that it will, but I don't care if it does. If it does, great. I just bought a bunch more silver for cheaper. I'll buy more. I don't care. I'm going to cost average down. And if it goes up from here, I'm fine. I have my silver. I'm good. I hope you do too. But this just, again, this can't end well. And when you look at all this stuff that's been happening over the years, and debt ceiling and kicking the can, I mean, everything, the debt itself across the world, this is a once-in-a-lifetime event that's about to happen. It's going to be generations before it happens again. The cycles say so, okay? So you have to position yourself now because you only have one shot at getting it right. And even if you're one of the ones that bought all in at $40-something, $45 silver, just sit back. I know it's a little painful. Just sit back and wait. Not only that, This entire time since 2011 when that happened, 12, 13, 14, 15, 16, 17, you had 6 years to buy on the way down, which would take your $45 cost average down. But you may have been so sick to your stomach, you said, no, I'm just going to leave it and not touch it. I hope to God some of you didn't say, oh, the elite defeated me, I sold off. No. Take care.